A few hours ago, we learned that a big Chicago firm, Ronin Capital, was unable to meet its capital requirements. This forced the Chicago Mercantile Exchange to invoke emergency rules and auction off its portfolio. Guy Adami, we lost a few hundred points toward the last hour. Do you think that news exacerbated the selling? And do you believe there are more firms like Ronin out there?
Yeah, that's been my concern, Brian. And listen, folks, it's Friday. We're 1 week closer to getting on the other side of this. I think everybody should take some comfort in that. But, yeah, I think that's exactly right. And that's something we've been talking about for a long time, that you're probably not going to see the bottom of this until you see a firm or a number of firms effectively blow up. And I think, so listen, I don't wish anybody any ill will whatsoever. But in terms of trying to identify a culmination of this, that's as good a sign as any. I also take some comfort in the fact that although I know the S&P was down big again today, I know that, I understand. I take some comfort at the fact that the bond market is showing some signs, and I know this sounds ridiculous when it's down 28 basis points, but at least it's showing some signs of stabilization. I think that's really encouraging, because if we start to lose that, then things get really scary. So that was encouraging.
Yeah.
So,
yeah, Tim,
there. And also, by the way, quickly, the VIX didn't explode as well. So although it's a painful day, you have to look for some green shoots, I think, Brian.
Yeah, we do. We certainly all need that right now. And, Tim, listen, there were some rattles out there in the mortgage-backed bond market. And, of course, that brings back a lot of thoughts of 2007, 2008. The Federal Reserve stepping into that market, getting notes from mortgage-backed bond traders today. That seemed to calm the market. I don't want to get in the weeds of mortgage-backed securities, but if we can sort of, put a Band-Aid on some of these issues now, should that calm the overall equity markets?
Yeah, but I think liquidity issues in the market are critical right now, and what we're hearing about with leverage players, hedge funds, obviously the derivative factor of the mortgage markets are part of what made 2008 extraordinary and extraordinarily difficult for not just policymakers, but for market participants. There's much less liquidity in the market today, sadly, and that's good and bad. The byproduct of taking leverage down at banks, at prop desks, et cetera, means that I don't think we have the same problems. The problems here are ones that are absolutely related to the stick being thrown in the bicycle spokes of the global economy and truly stopping. We're going to see earnings declines on the S&P. I think between 8 and 10%. It's impossible to know because it's impossible to know the duration. I also, though, read J.P. Morgan's piece today, and these are guys that are on our show on Fast Money all the time. Marco and crew say that you should be looking for 2021 of plus 15% in S&P. So obviously, as we know, the curve in terms of the virus and the peak impact is not only critical on a health perspective, and that's the most important thing right now, but it's critical for the markets in terms of how severe and how deep this contraction will be.
Yeah, listen, I think that we go through the markets this month, guys. This month, you're looking at crude oil down 49%, Bitcoin down 31%, the S&P down 31%. Everything that can be sold is apparently being sold. We got some data from EPFR. They track fund flows. $90 billion went into cash this week. Is cash still king, Guy Adami?
For right now, it is. Tim can speak to the U.S. dollar, but there clearly seems to be some rush for the quote unquote safe haven of the U.S. dollar. And let me be clear what I said at the top of the show. I didn't say we're a week away from this ending. I said we're 1 week down. So that makes, by definition, 1 week less than we have to deal with this. So, again, I'm trying to somehow assuage some concerns out there. I know there are a lot of people very upset, rightly so. But each week we can sort of plow through this is 1 week closer to getting to the other side, both hopefully on the health front and the economic front. In terms of what you said in the markets, I would say again, I never thought the S&P 500 should have been where it was in the first place. But I've been saying that for months and months and months, with the market just going up and up and up. So you can make an argument now we're getting to levels that probably have overshot to the downside, but I still think in terms of levels, we probably have another 8 to 10%. If you want an absolute level, I think Scott Miner had mentioned 1,700 in the S&P, which technicians will point to. I would point more like 2030, which would be the 50% retracement of all things, the March '09 low and the recent all-time high. So those are the things you need to be looking at. Again, I understand it's extraordinarily scary out there, but each day that goes by, we're one day closer to getting to the other side. That was my point.
Well, 2030 on the S&P 500, Tim Seymour, would be about 11% or so from where we are right now. 1,700 would be an entirely different story. On a market already down 30% this month, do you see that much more downside coming as well? Or do you disagree with Guy?
Well, I think it's impossible to make this call. I think markets are reacting to the velocity of the move. And actually, you know, as I think Guy's talking about the relative victories of where we've traded over the last 5 days, you can make an argument that the market's actually in a wide range, but has been thrashing around this kind of 23 to 2,400 level. And the fact that, you know, if you look at the peak of the financial crisis where VIX levels got up to where we got earlier in the week, you started to then see this moment where, you know, for example, from I think, you know, October 24th to November 3rd or 4th, the VIX declined by about 45%. Today, as we got below 50, and if you look at the chart, you can only hold extreme volatility that high. I don't think that that's going to be the end. And I think what we'll do is we'll continue to trade lower into next week, especially if the policymakers continue to step forward. Clearly, local and state governments, on top of what the feds are doing, are being very aggressive in terms of trying to change not only the behavior, but the tone of the response. And I think that's good for volatility. Those are scary headlines. Like, I live in New York. I live in New York State. Those are headlines that a lot of people were reaching out and talking about and are fearful of. But those are the kinds of responses that we need to have to this health crisis, which is leading to an economic crisis. Let's get health and policy moving in the same direction. And I think the markets, in terms of a volatility perspective, I think are going to trade lower.
Yeah, and, you know, listen, Guy Adami, I'm hearing from people that, and it's a very sensitive topic, and you don't want to come across as being crass in any way or unfeeling or uncaring, because none of us are. But I'm hearing from a lot of people saying, when do we balance out the economic considerations of this? That we've got to consider where we may be in 4 to 6 months economically and health-wise, and how do we balance that out? And I'm also hearing from people saying that there's a panic in the market in part because politicians seem like they are panicking. Do you feel like there's anything improper in any of those statements? Well,
I mean, I'll say this. I put no trust in our politicians whatsoever. What I put a great deal of trust in is the goodwill of our fellow citizens, and I think you're seeing that all around the country right now. So I don't think any of us are relying upon the intellect or the insight that many of these men and women have. I know I'm not, but what I am relying on is the fact that I can do something for my neighbor, and hopefully my neighbor can do something for somebody else. And I think that's what will get us through it. That's what's gotten us through things in the past, and will get us through this one as well. And that's not me being Pollyanna-ish. That's the reality of the United States. When we face a common enemy, we put our differences aside and we do what's best for our neighbors. And that is my answer to that question. Now, again, I have no idea how this goes on, how long it goes on for. But, you know, each day that we can sort of plow through and get close to the other side is a good day. That's my point. Yeah. And I think that's the way we have to look at it.
Tim,
you know, we're just sort of crossing off days on the calendar right now.
Yeah, and Tim, you and your family live in New York City, so obviously you're in it more than I am. Do you agree, just as a person, not as a trader, about the policy response? Do you feel like it is appropriate? Do you feel like it is maybe sufficient or insufficient?
I think the most extreme policy socially we can exert that allows people to live their lives and doesn't create hysteria, but talking, government officials talking in stern, real, in many cases restrictive tones and edicts is important. The sense that we're going to be different in this country than the rest of the world. We are different in this country, but this epidemic will react the exact same way. We have to let this curve get knocked down, and then ultimately we're going to have to pick up the economic pieces. And, back to the markets, the things that the market is trading on are these new headlines. The next phase is going to certainly be the job losses. Today, the market rhetoric certainly was focused on the jobless claims number that we'll get next Thursday. There's a lot of estimates that have come out. And, people are, again, all over the map on the bid ask, but 2 million to 2.5 million is probably somewhere in the mean. And that's shocking.
Yeah.
This is the type of job loss that we haven't seen in this country in a long time. And it wasn't this extreme and as overnight in the financial crisis, even though that was about, changing the job loss trajectory. And that was one of the first things that the Fed went after when they came in and started to create monetary policy response. But I'm not sure that we've got that support here again. So we came into this at peak employment. We came into this at extreme market levels and extreme valuations. That has as much to do with where we are in the markets right now as obviously putting the virus in the context of all that.